Good day, everyone. I am Tabinas Maria Eliza from the Group 5. In this chapter, we have discussed specific analysis that holds particular significance for the investors. First is the earnings per share. Earnings per share is a company's net profit divided by the number of common shares it has outstanding. It is essentially a measure of how much of the company's pie each shareholder gets. A higher earnings per share generally indicates a more profitable company and a more attractive investment. Here is an example. Mr. Reyes runs a company under the name of Malco Enterprises, and here are some of its financial details. Net income at the end of 2020 is equals to $450,000. The preferred dividends paid in 2020 is equals to $30,000, and its average outstanding common shares is equals to 70,000 shares. The formula for earnings per share is equals to net income minus preferred dividends divided by its average outstanding common shares. First, we have to calculate the total available earnings for common shareholders. It is in net income minus preferred dividends. $450,000, which is the net income, minus $30,000, which is the preferred dividends, and that would be equals to $420,000. Let us now calculate the earnings per share. $420,000 divided by its average outstanding common shares, which is 70,000, and that would be equal $6 per share. This means that for every share of common stock owned, the shareholder receives $6 of the company's profit. Let us now discuss the percentage of earnings retained. The percentage of earnings retained, also known as the retention ratio or plowback ratio, measures the portion of a company's net income that is reinvested back into the business rather than being paid out to shareholders as dividends. It tells investors how aggressively a company is reinvesting for future growth. Here is an example. Alice owns a software business that focuses on web design. She recorded a net income of $10,000 and paid out $2,000 in dividends. Calculate her business's retention ratio. Here is the formula for percentage of earnings retained. It is equals to net income minus dividends divided by the net income. First, we have to compute for the earnings retained. That would be net income minus dividends. $10,000, which is the net income, minus $2,000, which is the dividends, and that would be equals to $8,000. Let us now compute for the percentage. $8,000 minus the net income, which is $10,000, and that would be equals to 0.08. To get the percentage, we have to multiply it by 100. 0.08 times 100 is equals to 80%. In this scenario, Alice's business retains 80% of its earnings for reinvestment in the business. The remaining 20% is paid out to shareholders as dividends. Let us now discuss the dividend payout. Dividend payout is the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. Here is an example. Johnny Company comparative income statement for the years ended December 31, 2019 and 2018. Its income before income tax is $314,000 and its income tax expense is $66,000. The net income would be $248,000. Johnny Company comparative retained earnings statement for the years ended December 31, 2019 and 2018. Its retained earnings for the beginning of the year is $2,198,000. Net income $248,000. Less preferred stock dividends, which is $12,000, and the common stock dividends $8,000. Its increase in retained earnings is $20,000. And the retained earnings for the end of the year is $2,426,000. The formula for dividend payout is equals to common stock dividends divided by its net income. And from the given example, the common stock dividends is $8,000 and the net income is $248. Let us now compute for the dividend payout. $8,000, which is the common stock dividends, divided by its net income, which is $248,000, and that would be 0.0323. To get the percentage, we have to multiply it by 100. 0.0323 times 100 is equals to 3.23%. To interpret the ratio we just calculated, the company made the decision to pay out 3.23% of its net earnings to its shareholders via dividends. The remaining 96.77% of its net income for reinvesting needs. Let us now proceed with dividend yield. Dividend yield is a financial ratio that measures the annual dividend per share paid by a company relative to its current stock price. It's expressed as a percentage, showing the proportion of the stock price that investors receive in dividends annually. Here is an example. Let's say that the annual dividend per share for Mrs. Reyes's company is $6 and its current share price is $270. Let us now compute for the dividend yield. The formula for dividend yield is equals to annual dividends per share divided by the current share price. From the given example, the annual dividends per share is $6 and the current share price is $270. And that would be $6 divided by $270. That is equals to 0.2222. To get the percentage, we have to multiply it by 100. 0.2222 times 100 is equals to 2.22%. This means that the company's dividend yield is 2.22%. This means for every $100 invested in Mrs. Reyes's company stock, an investor can expect to receive $2.22 in dividends annually. Lastly, the price or earnings ratio. Price or earnings ratio is a metric that investors use to calculate which company shares are more profitable for investors. Here is an example. Let's calculate the price or earning ratio for Walmart as of February 3, 2021, when the market price of a share of the company is $150. The company's earnings per share for the fiscal year ending January 31, 2021 was $15. The formula for price or earning ratio is equals to market price per share divided by the earnings per share. From the given example, the market price per share is $150 and the earnings per share is $15. Let us now compute for the price or earning ratio. $150 divided by $15 is equals to 10. This means that it can be seen that the price or earning ratio of Walmart is 10, which means that investors are willing to pay $10 for every dollar of the company's earnings. That would be all for my presentation. I hope you learned a lot from me. Thank you for listening.